Holy moly, we are live. My home office here in Utah, Southern Utah. Let me get my microphone a little bit closer. We are going to answer some questions live and alive. All right, let's see. So if you're in the chat, if there's any questions you have about buying a home, real estate financing, mortgage loans, anything like that, go ahead and submit a question there. I'll try to keep an eye on that. But I do have some questions that I found through some online platforms and stuff like that that might just be really interesting and really relevant. So let me jump into a couple of those real quick while we're waiting for anybody to jump on. This is an interesting one that I saw that it actually comes up in a couple different formats. Maybe this one's just worded a little bit differently. So I thought it'd be interesting to talk about that real quick. It says, if you take out a home loan and then don't buy the house, what happens? So you really can't, it's not like you get approved for a home loan. They give you the money and then you go find the house. And if it doesn't fall through, the money just gets returned. So you really don't get the house until the loan's ready. So once the paperwork, appraisal, all the stuff's done for the home loan, you go in and sign the paperwork. They don't release the funds until they're recording on that house. So if you end up backing out of the house, so let's say you do a home inspection and you find out there's problems with the home, or you just decide you don't want the house anymore, but you're already approved for that home loan. You actually don't have the loan yet until it actually records and funds and on title and all those types of things. So it works a little differently than other types of loans in that sense, but you don't just take out a home loan without having a home attached to it. So you can't just say, hey, I need $100,000 loan against any home or this home, and I don't want that home, so I just keep the 100,000 or 200,000, whatever the numbers are. It is something where once you're approved or pre-approved for the home loan, there's still a whole bunch of steps before they actually fund and record the loan. The recording of the loan, recording that deed against that new home, that's when it's officially done. You've got the loan, you've got the home, all those things. So there is some steps that you have to follow before the loan even happens. So you're not going to have the home loan without the home it goes to, if that makes sense. Let's see if anybody has jumped on just yet. So this is the first time I've done the live. I thought I would just check it out. That's why I'm in my home office now, and thought I was kind of playing with my YouTube channel and I was doing a few things. So I just wanted to jump on here live and just see if anybody jumps on and see if I can answer any questions for you. So let's see if we can find a few more. Let's see. Let's see. Let's go into the real estate tab here. There's always usually some pretty good questions in there. Let's see. Why are more first-time home buyers opting for longer mortgage terms? Not sure what they mean by that. We are starting to see the 40-year mortgage pop up a lot more often. And honestly, there's not a crazy amount of benefit to it. It's not really lowering the payment. Now, on the very high-end homes, maybe it benefits a little bit, but it's crazy how much adding 120 payments, 10 more years to a loan, the way the amortization schedule works, it doesn't lower the payment, but it costs so much more money. So it's something where that 30-year, it's just the way the math works, that really is one of the better options. And even the first 5 years of most 30-year fixed mortgages is almost all interest anyway. So adding another 10 years to the loan isn't really going to be hugely beneficial. And there's even a lot of programs like the traditional government-backed, some loans won't probably ever do a 40-year loan. You're just seeing that pop up maybe a little more often in some of the higher end type loans where they do offer that 40-year fixed. But it is much more common. So first-time home buyers, I don't know any first-time home buyer loan program that goes to a 40-year fixed, but a first-time home buyer may look at that depending on if it just makes benefits or just makes sense. But I'll tell you, if you run the math on it, it's crazy. 120 more payments, how much it reduces the payment. Most people don't opt for it. They really don't. Let's see. How can potential home buyers find the best mortgage rates? I often tell people all the time, the money is all coming from the same sources. The guidelines are all coming from the same sources. There isn't usually huge differences between lenders. Now, certain programs might be different for sure. So finding out what loan program you qualify for can narrow down the benefits and disadvantages of each loan program. So it is something where that's probably the bigger differential. You might have a lower rate but higher mortgage insurance or vice versa on the different types of programs. But it's crazy. We all get the money from the same sources. We're all checking everybody's different rates any given day. They do fluctuate and change. The program usually changes rates way more than the than the particular mortgage company you're working for. Now, loan officers get compensated at different rates as well, and that will change the rates or the fees that are collected. So a lot of it will come down to who you're working with just as much as anything else. So the best rates that are out there, the best thing you can do is keep your qualifications as high as possible so you're qualifying for the higher programs. That's really the best way to get the best mortgage rates. If you can jump in the chat, you can ask any questions in there, and I'll answer those here as we're going along. Let's see what else we got. Uh, Let's see. Is your house included in your net worth despite having a mortgage? Yes. Now, a lot of times you'll see calculations that minuses off the debts, but usually what they'll do is have all the assets in one column, all the liabilities in the other, and then the difference. So it is something where the house should be included in that because that still is an asset, just like a car or other assets. It just is looked at differently because there is maybe a gross amount and a net amount you have to make an adjustment for. But home should be included in the net worth, absolutely. But then there's the net obligations on the other column, that's going to show what your actual net worth is. Let's see. If I'm paying off $1 million mortgage, am I considered rich? What's your definition of rich? Is money the only thing that makes you rich? That's probably the first question I would have there. And the second thing, it depends on what the home is worth. If you're paying off $1 million mortgage, the only way it's worth any money is if you sell that asset. So you might be equity rich. Now it sounds like you've got a lot of equity, but getting to it might be a little trickier than having the same money in the bank. But I mean, yeah, if you're paying off $1 million mortgage, where that money's coming from, how it's being collected, I mean, there's definitely some richness in that. But I would say there's a lot more factors on what makes you rich than just having a free and clear home that's worth a lot more, or where that $1 million loan would be paid off at. So I think it's I don't know. I don't look at richness that way. I look at richness as how much time do you have? How's your health? How's your stress levels on what debt you have to service, that type of thing, instead of having the cars and the houses and all that kind of stuff. That's great. I mean, that's great. But what are you doing with your time? That's where I think richness really comes from. And that's where real estate can help you by being able to have a little more free time, have a little bit more safety nets and fallback and things like that are tied to real estate. Let's see. What are some reasons that a seller might refuse a full price offer on the house? That's a great question. So, a reason why somebody might not accept a full price offer is maybe there's contingencies, maybe the time frame, maybe there's something else in the contract. It's not just price. There's other things that are in that contract that maybe the seller just doesn't want. Maybe it's like a long closing, or maybe it's contingent on selling another house. Maybe there's other things within the contract that the seller might say, there may be another offer that might come in that will get me more than just the price. Now, price is a big part. Absolutely. I mean, a lot of the other things won't get looked at when you get the full price, but that's the only thing. If it's a full price offer, maybe it's somewhere they can't close for 60 days or 90 days, or maybe it's contingent on selling another house. So they have to wait for that house to sell to get their full price. Maybe there's something else in the thing that says, hey, I want you to include the furniture or the hot tub or other things within the home. They don't really want to include those things as part of the price. So it's not just the sales price that maybe somebody will refuse. I mean, it's more rare for sure. If they get their offer price, then you're not going to see them maybe as worried about the other things, but there's still other things in the contract that may determine if a seller wants to sell. Let's see. Ooh, what are the steps involved in a loan or mortgage process? Okay, you got to cut off this arm. Firstborn, secondborn, depending. So the steps involved in getting a mortgage loan is definitely steps. There's not just one thing you're going to do. The most important step is to do the actual application. This is a whole bunch of different sections that help us qualify you for the different types of loans. But once that application process is done, then get into the verification process to verify what we put on the application is accurate. So there's income section, debt sections, there's declarations on if you've had bankruptcies or foreclosures, job history, employment history. Those things are listed on there. So the application really helps us immensely. It gets a lot done with just that application. And the more thorough and accurate that is, the less problems you'll have down the road. You'll have a lot of times where somebody will tell you kind of just what they think their income is. I make X amount per hour, work this many hours. But then you get their pay stubs and maybe they took a bunch of time off in the middle of the year. So their year to date is lower. Or they'll say they have a certain credit score, and when you pull it, it's not there. Or they'll have more debts than are listed, or they'll have child support or alimony, separate maintenance, something else that's owed. or they have an HOA payment that wasn't disclosed, or a rental property, or something else can pop up. But the application really is that most crucial starting point. It helps us narrow down what other documentation we're going to need, what programs you may or may not qualify for. And then most of the process from that is verifying what we put on the application or adjusting it. So as we get new information like the pay stubs, W 2, tax returns, whatever income we're using to verify, we match it up with what we first had. Now, that doesn't mean at the beginning stage that if you say, hey, I make 5 grand a month and it ends up being 48, 3286 or something, it ends up being a different number, that we can't adjust it. So there's always kind of the initial application. And as new information comes in, we make adjustments. Then there's like a final application that's signed at closing typically, that is everything we've been able to verify that got you approved for that loan. So, what are the steps involved? The mortgage application is going through those sections. There's little sections on the application. It used to be called the 1003. Now, more commonly, it's called the ERLA, which is the Uniform Residential Loan Application. It has just sections that you have to go through. It's really it's changed a lot. The new forms we use have a little bit more information. New boxes kind of open up if a question is yes or no, and it's changed there dramatically as mortgage loans have evolved and the things that we need have evolved, and systems and the way people earn income and the way they have their assets. I mean, it's always evolving. So these forms are always trying to keep up the best they can. So the steps involved is really going through with a loan officer and reviewing kind of some of those things. But just know if you don't know something or you're not quite sure, you can leave that box empty for the beginning stages. And as we get new information, we kind of go back through and check those off. Obviously, the more accurate from the beginning, the more likely we'll have issues down the road. But I've seen times where people fill out half of that application because we just don't know yet. We don't have a property picked out. Maybe there's a change in jobs. Maybe there's just things we don't know. Maybe the wife takes care of things, the husband takes care of things. You just don't know all the questions right up front. But at least we can get a rough idea, kind of where we're at, what we're headed, and what other stuff we're going to need. If you have any questions, go ahead and jump in the chat and we'll answer those questions later. Let's see what else we got here. I wonder if there's a way. Okay. This is the first time I've done this stream. I think I just thought I would jump on and check it out. Let's see what else we got. Oh, let's see. How do I negotiate mortgage forbearance? So, a forbearance plan is basically a way to avoid foreclosure. So, if you're in a situation where maybe you've gotten a notice of default, you know you've missed, maybe you've lost your job, or something's going to happen where you're going to have a hard time making the payment, a lot of times talking with your lender to be able to work out a forbearance plan, which is basically says, hey, let's lower the payment or modify this payment until I get back on track or this or that. And they'll work with that servicer or that lender to really try to keep you in the house. And I would say lenders aren't in the business of foreclosing. They don't want to just take over your house. You may think that, but they don't. There's a lot of laws and regulations and stuff that happens once that goes into a schedule of real estate, once that goes into foreclosure notices, all this stuff, attorney fees, all that type of stuff. Generally, they want to keep you in the house if they can, especially if it's a temporary layoff, a medical situation. There's a lot of ways why the lender will say, okay, we'll temporarily lower your payment to X, and then it'll go back to the original payment, or there's ways to work it out. The best thing to do is call the servicer, be upfront and honest with what's going on, and see what options they have internally. Maybe they won't. Maybe your situation won't. They're just going to say, sorry, if you missed your payment, the collateral is the house. But generally speaking, there will be some programs that the earlier, the better. I see too many people that if they have these problems and they just kind of bury their head in the sand, hoping it'll go away, and they'll just sit there forever. And then they do the notice of default, wait the 90-day, wait till the last second. You're far better off to start talking with your lender earlier in the process to just notify them what's going on, see if they have any programs you qualify for. So that word forbearance is just a way to avoid foreclosure. You come up with some other way to make the payment, delay payments, lessen the payments, something to allow yourself to get kind of caught up. Let's see what else do you. Let's see. How can I make more money in real estate as a realtor? So sell more real estate. It's just like any sales job. You either find higher listings, work that much harder. I mean, I think it's one of the few industries that really does benefit those that are out there working hard. And it is a hard business. It is, especially the first couple of years. There's a lot of competition in the industry. How do you make more money? You're in an industry that really the sky really is the limit. There's people that can make a lot of money in this particular industry. So the best thing to do is sell more homes, get out there more, knock more doors, go out there and just be out there more often and do what you can. So I mean, it's just like any other sales thing. You just got to sell more homes. That's what you got to do. Let's see. Let's see. Nothing against realtors, but Is selling a home by owner really that complicated, especially if you have a house that you know would sell quickly? So I'm a big believer in real estate agents. I really am. I've been doing this a long time. There's a lot of things that they're going to do that will smooth out the process, that will help you get in front of more eyeballs, that will help you smooth out the bumps. Now, all of the bumps, of course not. It's a complicated transaction. There's a lot of things that are going on. And I would tell you this as well. I've seen this so many times when people are for sale by owners, they don't get the full price because almost everybody says, okay, if you're asking this amount, you don't have an agent, I'm just going to take 6% right off the top. So it's crazy how often you're paying for a real estate agent without having the benefit of a real estate agent. So I'm telling you what, it's better in many cases to do it. But there's bad real estate agents out there, just like there's bad car salesmen, just like there's bad people. So interview, pre-screen, go out there and find the best agents. There's incredible real estate agents out there. And there's some that are just do one transaction a year, just kind of help out whenever they have somebody to sell. And there's just really good agents out there. Get an experienced agent, do some research, check to see who's out there selling business, selling properties, and go with that. Not just the first referral you get, not just XYZ agent that's in your family. Now, obviously, family, you want to try to give them the benefit of the doubt with some of this stuff. But I found that sometimes the family members are the worst ones. Yeah, I know there's something about mixing business and family that gets really tough. But I would say most of the time, a huge percentage of the time, you're much better off with a real estate agent as a buyer or a seller. I'm a big believer in real estate agents, but the right ones. Not every real estate agent is the same. Now, in my area, I see a lot of retirees, a lot of people that don't do a ton of business. So you have to kind of really go through that. But you can talk to title companies, talk to loan officers, talk to people that deal with real estate agents all the time, and they will tell you the best agents in every town, every county, every city, or at least give you a handful of them. And you can go out there and just kind of talk with them, interview them, see how much business they're doing, what marketing services they offer, just those types of things. You really want to interview the person that's going to be your agent. But is it really complicated? Yes. Yeah, it is more complicated than you think. You got to deal with title. You got to do homeowners inspections. You've got to deal with seller disclosures, the state disclosures. There is a lot going on. That doesn't mean you can't do it on your own, but I really am a big believer that most of the time you're paying for an agent, whether you use one or not, because somebody will just offer that lower price. But it doesn't mean you can't go out and do it on your own. The other thing you're going to see too, it depends on if you're in the home or not. I mean, if you're living in the home and you constantly have people kind of knocking on your door and calling your phone number, and you're going to get called by tons of real estate agents as well. Having someone to buffer those calls can be really helpful. So real estate agent really does a lot more kind of on that front end. Loan officers kind of take over in the middle-ish, and then everybody kind of comes together at that closing table and kind of pushes it over the finish line. But that middle part can be really a frustrating part with the process. And having somebody in your corner that's doing that negotiation, scheduling your showings, kind of coordinating any questions, giving you a buffer between you and the seller, I think it's well worth it. But if it's not, obviously try it on your own, negotiate the price of the commissions, work with the right real estate agents. That's where I see this question come from, is most people just use the wrong agent. That's really what it comes down to. There's a lot of them. The competition's pretty fierce, but if you use the right agent, the process will go better. It will go better if you use the right agent. All right, what else we got here? Oh, let's see if anybody's jumped on. This is my first time I've gone live. I don't even know if I'm doing it right. I could just be sitting here talking to myself, and I have no idea. Anyway, so yeah, I guess we'll see what happens. Let's go into another question. Home mortgages. Let's see if that gives us any new fun questions. Why are mortgage applications to refinance a home falling? I think that's what it looks like. It's spelled wrong here, but anyway, why are mortgage applications to refinance a home falling? Because there's not as much of a benefit to refi. That's simple as that. Because most people that have done loans in the last 5 years are somewhere in that 3 to 4 range, maybe lower, but they're kind of in that 3 to 4 range. Rates are now in the 6 to 7 range, depending on what type of qualifications you have. So why would somebody refinance from, say, 4 to 7? That's a 3% jump in their payment from even a few years ago. Now, if you're pulling out cash, getting rid of mortgage insurance, there may be some benefit to go up a little bit. But honestly, most people are doing second mortgages or just leaving their first mortgage alone and just doing an equity loan, second mortgage, home equity line of credit is what they're called, because now they're not raising all of their balance on their loan. They're only raising, maybe a smaller loan. So I think second mortgages are going to get really popular because a lot of people have a lot of equity. Equity's been there. Home prices haven't had this big crash over the last year. They've slowed. We've seen some areas that have slowed, but there hasn't been any kind of crash because the supply still isn't catching up. There's still more demand than supply because owning a home is great. It is a wonderful thing to own a home. Simple, simple as that. So it is something where refinance applications, I think, are going to be down for years to come. Maybe we'll see rates kind of top at 7. Maybe they will dip into that 5, and we'll see a little boom between those people in the last few years that have bought at a little higher rate. But we're not going to see like a boom that we've seen a couple times in the last 15 years as rates kind of went up. The HARP loan was really popular for a while, and then rates were kind of that 5% range for a while, and then dropped into those threes, and it was just a feeding frenzy. I saw a report that we did like 6 years worth of refis in like 18 months because everybody could take advantage of that lower interest rate. So it is something where that was such a big boom. It's almost like going to collapse any other boom in the future because rates are now in what really is more of a normal rate for a mortgage. Really, it is. To see rates in that 6, 7 range is much more realistic when you're talking $500,000 locked for 30 years. I mean, 3% just giving it away. So I think this rate is much more what you see as an average over the last 50 years. So until that either drops enough to take advantage of the people that have done a higher interest for loan, I don't see refis going up or really being a major part of the real estate market, the mortgage market for a long time. And I think a lot of mortgage companies see the same thing. And that's why you're seeing them close or shut down because a huge part of their business was refinance. Like I would say more than half of some mortgage companies were all refi based. So half their business just went away in the last 12 months. So there's always going to be much more of an emphasis on doing purchase business, construction loans, that type of thing. So simply the benefit to refi has gone down. There's not as much reason to refi. Let's see. Let's see. Can a home loan be taken for personal use? Yes, home loan's a very broad term, but you can get a mortgage and use that cash for basically whatever. Obviously, if you're going to say you're going to use it for illegal activity, I'm sure there's probably some guidelines that says nope, we're not going to give you the money for that. But generally speaking, a home loan, you can take that money, buy a car with it. You can take that money, do home improvements, pay off other debts, rainy day savings, buy another property. There really isn't anything that happens. Now, a lot of lenders will ask, okay, what's the money being used for? Mainly because they want to make sure that you're not acquiring new debt. So let's say, for instance, that you're pulling out money to buy another home. Well, there might be another expense tied to buying that home that they want to know, okay, now we got to add that to your debt ratio. So they will still ask what the cash is being used for. There's also some money laundering laws and things like that to make sure that the money's not being used for some sort of illegal activity. But honestly, what you use the money for personal use is fine. Whatever you're pulling out a second mortgage, whatever you're doing, in most cases, you're going to be totally fine. Let's see. Can we take a home loan for a unfurnished house? Yeah. Can we take a home loan for an unfurnished house? Most houses are unfurnished when you buy them. So I'm not sure what that question really means. So I don't think there's a home I've ever bought that came with the furniture. I think you can, if they're staged, maybe you can offer to say, I want that furniture as well. But I'd say most people are buying the home and they're bringing their own furniture with them or buying their furniture. And in fact, that's kind of one of the fun parts, honestly, buying a new house is this, being able to furnish it and maybe get some new stuff that kind of matches that new house. And that's kind of one of the fun things of buying a new house is also being able to kind of furnish it with your stuff or maybe get some stuff because a lot of times you'll see people that are going from maybe a smaller home to a bigger home and now they do need to get some other furniture or that type of thing. So you can take a home loan for an unfurnished house. The short answer is absolutely. Why wouldn't you be able to? In fact, most of the time you can't do a home loan that the furniture is included. So when you do the real estate contract, you have to basically say, okay, this furniture has no value because it's not actually part of the price. So let's say the house is, just use an easy number of $200,000 and there's $10,000 worth of furniture. So you're buying it for 210. Well, the house is really only worth two of that. So you basically have to make sure the value is equal to that. And you're basically transferring that personal belongings at no value. So it's actually probably the other way. It's harder to get the home loan when you include the furniture if the furniture is above what the value of the home is. So it's almost the other way around. Let's see what we got here. Let's see. What is the complete process for a bank for a home loan? The complete process? How much time we got? I mean, holy moly, there's a lot going on with a mortgage. So, what is the complete process for a bank on a home loan? Well, you start with the application, you verify the application, you appraise the asset, you check title, homeowners insurance, and property taxes. You go through an underwriting stage to see if that person's worth the risk, what rates and terms you're going to offer. You prepare the paperwork, goes to a title company typically, or maybe an attorney office, depending on the state you're in. I mean, there's a lot of little steps that go from start to finish. So, and then you fund that loan, it records, the loan becomes part of your portfolio. You either pull that money together and sell it off, or you keep it and retain those payments. So there's a lot going on. So it'd be interesting as what questions do you have? You can put them in the chat, or afterwards I can get to those questions. What questions do you have more, maybe more specific about the process? Like, what is the most confusing part of this whole thing? Is it the loan application? Is it the loan disclosures? Is it the appraisal or title or homeowners insurance? Is it the processing, underwriting, or funding the loan? Is that maybe the questions that most people have? I think most people have a question on the pre-approval part, or what loans they qualify for. I think that's the questions I get more often, is how do I know what loan I even qualify for? That's where you work with experts. That's where you work with mortgage lenders and loan officers to be able to figure out, okay, what are the benefits and disadvantages of all these mortgage programs out there? Because you'll qualify for usually more than one, but one of them will just stand out. One of them will just meet your needs. One of them will be either a cheaper payment or less money down, or there'll be all these different programs, and they all have little different niches they're trying to solve. So maybe they're geared towards first time home buyers, more money down, less money down, mortgage insurance, investment properties, second homes, manufactured homes, condos, townhomes. There's so many things out there, and there's a guideline for every one of them. So part of our job is to narrow that down for you, make sure we're qualifying for the best loan that you can qualify for. But sometimes, honestly, I've seen times where the lowest payment isn't necessarily the best loan, because maybe it's a shorter term loan, maybe it's an ARM, or maybe the lowest payment has higher mortgage insurance, or way less money down or more money down. I mean, there's more going on than just the payment. But that's obviously one of the most important parts, is what can you afford? What are you most comfortable with? And working that number to find the home that fits that. I think we've seen that big change where most of the time, okay, how do I, what's the payment on this? Now it's like, what's my payment? How much can I afford? Before it was much more, okay, I want that house. What's the payment? Now it's, I have the payment. Where's the house? Does that make sense? So it has really changed because of the change in interest rates, inventory, things like that. Excuse me. How much time we got here? I don't know how the timing works on the live chat. So, hey, you know what? I got nothing better to do. I might as well just answer some more questions for a minute. Wait for my wife to say supper's ready, right? Does anybody say supper anymore? Put in the comments. Do you say supper anymore? No, maybe it's a no. All right, let's see. How long does it take to get approved or denied for a home loan when applying through a local bank branch? So it really will come down to the program that you're looking for. There really is a pre-approval. Full approval takes longer, but knowing kind of that you're pre-approved in the sense, well, okay, based on what you've said for income, your credit scores, the property you're looking at buying, okay, you're pre-approved for this number. Now, once we find the home, it kind of plugs that in. Then you go through a full approval process. Once you're approved, that's when you'll get typically what's known as cleared to close. So all the other stuff is done, all that process is done. So to get a pre-approval can be very quick. I mean, you can do it 10, 15 minutes after doing the application, depending on how accurate and how complete the application is. If you just give name, phone number, social, and that's it, then maybe the pre-approval is not going to be very strong. But if you go through and go, okay, my income, my assets, my down payment, the program, kind of go through the entire list, that pre-approval will be much more solid. That can be literally minutes. You can go through that in minutes. The full approval, now you're talking about appraisal, title, homeowners insurance, verification of your income and assets. There's a lot more that goes to the full approval. And most of the time, you're going to be in that 14-day range up to 40 days, depending on the lender you're working with and the type of program that you're doing. So there isn't really just a one answer to that, because there's a lot of different loan programs and a lot of different guidelines and how easy it is to get the paperwork. But we've closed loans as quickly as 14 days. I've closed private money loans and those types of things in days, like a few days. We get a title report, we check the address, the exit strategy, what you're doing, and you're funded in a few days. I would say this as well, and this is a knock on local banks and things like that, but I'd say they're usually slower. Honestly, the local credit union bank, the guy that's sitting there, their underwriting's a little bit more strict. Their more loans are all funneled to like one underwriter, and I always hear people take a lot longer to get a loan through like their local little bank than they would if they use a mortgage professional mortgage lender or mortgage broker. Now that changes as loan volume and ups and downs of industry. We're also seeing a ton of support staff in the mortgage industry just getting laid off or furloughed or hours reduced. So it is something where I think our turn times probably will slow just because there's not as many support staff anymore because the volume is just down. There's just less mortgages out there, so they don't need 50 processors and underwriters in the back office. They can handle a lot less, so they can also cut their expenses so they can stay alive. That's one of the hardest expenses for mortgage companies, all the back end office stuff. Most loan officers are paid commission, so they're not really, other than benefits and that kind of thing, they're really not having to pay these salaries where a lot of support staff and all that is based on some sort of salary. But I've seen massive sacrifices made by corporations to keep as many people as they can. Really, layoffs have started to kind of roll, maybe not as quickly as I thought they would, honestly, but they're trying to keep people as long as we can, just kind of ride out this slowdown. But it is something where the time frame, really just talk with your loan officer. The loan program you're going to do is going to play a big part in that. And the more accurate the application, the more quickly you get the paperwork needed, that will really, really, really help speed up your time frame. On paperwork, now that we're going to get on a little soapbox, the most common paperwork errors that I see is people will take screenshots. They'll open up their mobile phone and they'll just do a screenshot of their bank statement, and that's what they'll send in. We can't use it. If you look at that, it doesn't have your name on there typically. It doesn't have even the bank's name on there sometimes. It doesn't have your anything to verify this is really your account. It could be so easily doctored that no lender is going to take it. They're going to want to see the actual statement. They're going to want to see the 30-day statement, where money's coming in and out, where that money came from. If there's all of a sudden this big, large deposit for 50 grand, they're going to say, wait, where'd that come from? If that's being used to buy this house, we need to know what that money came from. They also want to check to see if there's a crazy amount of NSFs, so insufficient funds, bounced checks, things like that. They're going to check those things as well. But the statement is what they need. And I have a lot of people that don't get mailed statements anymore. I don't know anybody that really does, but there's always a documents or statement tab with your bank that'll pull up in a whole, usually a year's worth of those statements as a PDF. So you just have to click on that, save it, email it, or upload it, however your loan officer wants to see that documentation. Then, but I'd say that's the most common thing is verifying those income and assets. I always get either just page one, or I just get a screenshot, or it's blurry or blocked out, or there's stuff that's happened to it. And really that's probably the biggest delay that you'll see is gathering up some of that paperwork. So the more you have it ready, the more you have access to your username and passwords for your payroll, your W-2s, those types of things, you'll really cut down on the time frame it takes to close a loan. So all that said, if you're looking to buy a home and you want a time frame, I would say that right now we're about 30 days from the time you get that acceptance to do everything. Give yourself enough time, unless you already got a head start. If you plan on 30 days, that's pretty normal for the industry. It can be quicker, especially if you've already got pre-approved and you've got all your kind of your paperwork ready to go and you're just out there trying to find a home. You can definitely close a lot quicker. But I would say it's really safe to be 30 days. All right, what do we got here? Anybody? Okay. Let's see. What else do we have here? I wonder if this is the first time I've gone live, like I said, so I'm really new to this stuff. Figured I'd stretch myself a little bit and just try to see who jumps on, or if they even know they can jump on. I mean, I don't know how this works. Let's see, live chat. See if anybody. I don't know what I'm doing. I know how to do mortgage loans, but this is all new stuff. So I'm just trying to just offer my talents and expertise and try to help people that are interested in buying a home. And I'm just in my home office today, so I thought I'm just going to jump on this. I have a channel here that I try to add content to, and just to try to help where I can. So hopefully the mic's working. I don't know. I don't even know if this gets posted, so I don't even know if you care. Who's out there? All right, let's see what else we got here. Let's see if we can do a couple more and we'll call it a night. How about that? Let's see. Can you change your name on home application if you don't own? Can you change your name on a home loan application if you don't own the home? Yes. Can you change your name on the home loan application if you don't own the home? I wonder if that means if the loan's already closed and you need to change your name. Obviously, if it's a legal name change, you can. But if you're in the application stage, you don't own the home yet, so you can make any changes to that that are necessary. So I think that question's a little confusing. Can you change your name on a home loan application if you don't own the home? You don't own the home until you've done the loan. The application is to start the loan process. So I'm going to say yes. Let's see. What are some reasons why a lender might foreclose on a home loan? Very simple. You violated the terms of the note. Most commonly, you've missed the payments. That's why they foreclose on a home. Now, they're not going to just foreclose because they can. In fact, they can't. They have to show you missed and defaulted on the obligation of that note. So most conforming and normal notes are going to have certain waiting periods. You're going to have, okay, you've got a grace period for the first 15 days. After 30 days, if you haven't made your payment, they can start that process to foreclose. In most states and most around the country, once they give you a notice of default, there's a 90-day waiting period before they can start taking the next steps of announcing essentially to the public that they're going to set a date and they're going to say, okay, this person's missed their payment. We bid this amount on the home, and then they either retain the home or another investor buys the house. So it is something where they're not going to just foreclose because they don't like the color you painted the living room or that you lost your job. And as long as the payments are made, if you haven't defaulted on the terms of the loan, they won't start foreclosure. So you want to take a look at your note. The note is what triggers foreclosure. If there's some clause or something in there, if you did fraud or violated the use of the property, I mean, there's some things that if you start bringing like chemicals and stuff onto the property, there is some clauses in there that says that if you don't pay your HOA payment, there is little clauses in there where they can trigger it. But I'd say I can't think of any other reason why a lender is going to foreclose other than you missed the payment. That's the reason they foreclose. That's their collateral. You've missed your payment. They're going to start those processes. Let's see. I don't. Okay, I'm just trying to see if I'm doing everything right. Don't even know who can see this or when they can see it, but we're just going to stay live and see what happens. How much home loan amount is safe? So really it's what you can afford. It's cash flow. It's about being able to comfortably make the payment as much as you can. It's not overextending in other areas. You've got the home loan, you got the utilities, you got your other expenses. Those are all things that can add risk to just your life in general. So having a home loan amount, what is safe, is going to really come down to debt ratio and how much you owe versus what it's worth. Those are kind of what I would say. How much is a loan is safe is really what you can comfortably make the payment for. And we have debt ratios and requirements that we have to show that we're not just going to say, okay, this guy makes $3,000 a month. We're going to give him a $2,800 house payment. We're not going to, it's not even going to get qualified. That now there's loan programs that can be stated income. There's loan programs that can be different because maybe they make more than what they can actually show because they have expenses or whatever on their self-employment and blah, blah, blah. But it is something where how much home loan amount is safe really comes down to debt flow or debt servicing, cash flow. That's what really you should be looking at to borrow and be safe with your payment. Let's see. What are the pros and cons of investing in an interest-only home loan before the rate hike by banks? So, interest only can be a benefit if it's a shorter term loan, if you're not planning on keeping it maybe for 30 years, maybe it's an investment property, maybe it's something where you've got an inheritance coming in or you got other properties you're going to sell and you can pay down the loan. So, most of the subprime, non QM, these other little programs that allow for interest only are not designed to be long term loans. So, if your situation is going to be changing, you're going to be selling the house, maybe you're in an industry where you work in an area for a couple of years, then you have to move and relocate. And there's a lot of reasons why this can be a benefit, but just realize that minimum payment is only the interest. So you're not paying anything to principal. So if you keep that loan 4 or 5 or 6 years and only make that payment, you haven't put anything towards principal. But maybe that doesn't matter to you. Maybe it's something where I'm only going to put 1,000 towards principal anyway. So why don't I just keep the difference? So, but I would just say a lot more people that gravitate towards an interest only loan, knowing it's more designed to be temporary for whatever reason. And that's where you want to be able to know what your outs are and know how long you're going to keep that loan before you only do an interest only loan. Now, why is it a benefit to do an interest only loan depending on rate hike? It really doesn't matter. It doesn't matter where rates are going. If you're looking at an interest only loan because you're worried about rates going up, well, what's going to happen when that interest only period either expires or runs out or something changes? Then you're also refinancing to a higher cost basis anyway. So even if rates are going down, that doesn't really change why you would do an interest only loan. I think that's maybe the wrong question about an interest only loan. It's really cash flowing. If you have the income coming in, if you're going to pay the extra or refinance or sell or do something in a shorter window, that's where these loans can have a little bit of benefit on that shorter payment during kind of that temporary loan. So that's how I'd answer that one. Let's see. Let's see. How do I get the cheapest home loan? And is a mortgage loan available for people with bad credit? Of course it is. There's people that'll loan to every kind of credit situation. But here's the thing. Why would somebody with bad credit get the cheapest mortgage loan that's out there? That's a risk factor. So you're going to say, okay, I've got this 500 credit score. I want the cheapest interest rate. But then you got the guy next to you that I've got an 800 credit score. Which should get the better interest rate? Well, he's managed, he's budgeted, he's not overextended. Now, there's reasons why somebody might have a lower credit score. I totally get it. Medical, things out of your control. I totally get it. And there's other reasons why people get different interest rates than just credit score. But it is something, the reason why you get better loans with better credit is you have a history of doing better with loans. You have a history of paying your payments on time, not going into collections, not not just blowing people off and saying, well, hey, I turned that phone back in. I don't owe them any money. I'm just going to ignore them, or I didn't turn off those utility bills. There's legitimate things that happen. I'm not saying that every person with bad credit has, sob stories or and that aren't true, but I'm also not saying that every mortgage or every utility company that reports bad credit is a bad person as well. So it really, credit is one major factor on getting the better interest rates. So my question for people that always say, hey, I want to get the best interest rate, but I have bad credit. Why is your credit bad? What are things we can do to help you with your credit? Can we start going through the dispute process? Maybe help you with some budgeting. Most people have bad credit don't budget. They just don't budget. They get their money, they spend it, they run out of money, and all of a sudden another bill is due or something happens. So one of the best ways to get out of bad credit is start saving and tracking where your money is going. You'll be amazed at where it's going. You'll be sometimes you're like, I didn't realize I was spending that money on XYZ. I can cut that back and not really dramatically change my lifestyle. And you'll get more reward out of seeing your reserves and your savings and things go up and your credit start going up than just trying to figure out a way to get the cheapest interest rate with bad credit. You're way better off to work the system by getting better credit. There's ways to get better credit. It might take more time. It might take some hard payments. It may have to go back to stuff that happened years ago that you just kind of hoped would ignore and go away. Maybe you got bad advice about paying debts or whatever it is. So it is something where work on your credit will get you better loans. It'll get you better insurance. It'll get you better everything with the credit scores being higher. So work on that first. Get some pride in what your credit score is. Start taking some accountability of where your money's going and get your credit scores up. Then you will get better loans, period. How are we doing on time? Ooh, we're at 40 something minutes. All right. Let's see. Let's see. How can one tell if their parents are paying for their home loan and not making them pay it? Well, how can one tell if their parents are paying for their home loan and not making them pay it themselves? I have no idea. And not making them pay it themselves. I don't know. That question's really phrased weird. Okay. Let's see. What is a balance transfer on a home loan and how to do it to save on interest? What is a balance transfer on a home loan? Okay. Let's see. What percentage of homeowners liability? I'm finding a couple more here. Let's jump into it. Let's do a little refresh here and see if there's any new. Having fun on a Thursday night, depending on when you're watching this. I don't know. Depends on when you're watching. If you do have any questions, post them, and maybe I'll put them in a future video. If you have anything you want me to do a deeper dive on, love to do a video. If you have any ideas for me, I'm always looking to offer expertise. All right, let's do. I'm losing the stream. Losing the stream, people. Oh no. I should put that standby thing up on the screen, like technical difficulties as we try to find. All right. What made you smile instantly? Oh, man. That's cute. All right. Let's see. Why am I not finding? Let's see. What stops someone from buying houses with a mortgage and having the tenant pay the mortgage in their rent? Why not do this with 50 houses? Great. Go qualify for 50 mortgages. See how fun that's going to be. So, what stops somebody from buying a house with a mortgage and having the tenant pay the mortgage? Well, that's what everybody does. That's what almost everybody does. Hopefully, the tenant's paying more than what the mortgage is. So, that's the idea. That's why you have people that have the properties. But I'll tell you this, you're not getting 100% financing on 50 investment properties. In fact, the guidelines really have for and this is for Fannie Freddie guidelines. There's other lenders that have different guidelines, of course, but that's the cheapest ease, not necessarily easiest, but that's the cheapest money you're going to get is if you can follow those guidelines. They have guidelines if you have up to 4 properties. Then the guidelines change up to 7 properties, then up to 10, and then they stop financing. They only finance up to 10. After that, you're going to have to go to other types of financing sources. You're going to have to go to people that don't do it through Fannie and Freddie. You're talking higher interest rates. You're talking those types of things. Also, investment properties will never be 100% financing. There's not mortgage insurance. There's too much risk on investment properties. You're going to be talking anywhere between 20, 25, 30% down to buy an investment property. So, really, to be able to sit here and, I mean, it's obviously an oversimplified question, but to buy 50 rental properties, you're going to have a significant amount of cash to be able to buy that many properties. And honestly, you're going to have to probably have that much money down to help cash flow from what the mortgage payment is to what the actual rents are in that area. The most common way I see people getting into real estate investing is they'll buy a home, turn that into a rental, go buy another house, or take the equity from this one, maybe buy one or two other ones, or that's how you kind of start growing your portfolio is taking the equity from homes. And maybe as you start earning more income as your career starts to go up, as you're doing this, you can start having a little more money you can throw into real estate. There's other things you can do with fix and flips. Maybe you maybe you're able to find a property that needs fixing and you can sell it and take that equity and roll it into another one. I mean, it's not an overnight thing. It's never going to be an overnight thing. And really, I own a bunch of properties. I wouldn't want to take on 50 overnight anyway. That would be just a lot of moving parts, a lot of cash, a lot of debt servicing and managing people, renting, and problems with the houses. I mean, that's a lot to manage, like right off the bat. Now, building up to that, it's a lot easier. I mean, it really is easier to kind of build with it and figure out what your niche is. Like a lot of people are real estate investing in short term rentals, some are long term rentals, some are fix and flip, some are fix and hold, some are wholesale. I mean, there's lots of ways you can make money in the real estate world, and some is more exciting to others depending on your temperament and what you want to do. And if you want to be the guy swinging the hammer on fixing it, or if you just want to be the one financing and finding renters, if you want a property manager, if you want all that stuff, there's so many fun things to do with real estate. So this is what people are doing. But I see a lot of them start with a home, maybe as a primary residence. They live in it maybe a year or two, whatever it is. And then they take that home, turn it into a rental, move on to the next one, maybe move on to the next two, maybe, kind of keep them. They just start building this investment portfolio. So that's usually a really good way to start. When should you refinance a mortgage? When it benefits you, when it makes a better payment, when you need cash back, that's when you should refinance, is really when it gives you better loan terms than you currently have. That's really as simple as that. Let's see what it is. Let's see how we doing on time. Okay. Does paying off a mortgage early make sense? Boy, that's a great question. I don't think so in many cases, especially the people that bought a few years ago, because the money that they have out on a mortgage at 3 or 4%, when you can get a money market account, I started seeing money market accounts that are getting in the fives, and sixes on money market accounts because of how the interest rates have gone up. So why in the world would you pay off a 3% mortgage and tie up $400,000 in a house when you could take that money and earn a better rate of return? Now, it depends on your rates and terms, depending on what you're doing. But I really feel that you should keep the mortgage, take whatever you're going to put in mortgage and use it for savings, get rid of any other debt. There's way more ways to use that money than tying it up in a home. Here's kind of my soapbox when it comes to that. How do you get the money back when you sell off or when you pay off a home? When you have a mortgage, you pay it off, you take all your savings, you take your emergency, you take your inheritance, you take whatever and just get rid of that mortgage payment. I just can't make a $2,500 payment every month. I want that thing gone. But it's going to take me 400 grand to get rid of that payment. Then what happens? How do you get the money back? How do you get the money back? You have to sell or refinance the home to get the money back versus having that same 400,000 in an account, earning interest, paying off other debts, emergency savings, whatever it is. I think it's way better in here, depending on where you use that money. There's a balance, of course. Maybe it's something where you pay down some of it or take some of it and put it in. I just think there's better places to diversify. We always talk about diversification. You wouldn't take all 400,000, buy one gold bar with it or one stock. They tell you, oh, you want to diversify index funds, stocks, bonds, annuities, whatever you want to do. Nobody ever tells you to take all that money and put it into one security instrument. Why would you use it all to pay off your mortgage, especially depending on what rate you've got? You're far better off to have that money more liquid in other places than tied up into a vehicle that will appreciate, excuse me, will appreciate regardless of what you owe. So if you pay off the home, does it make it worth more all of a sudden? Or is it still worth the same amount whether you owe 100% or zero? It doesn't make a difference what you owe on the home when it comes to what it's worth. Now, you obviously don't want to owe more than it's worth. You don't want to get in a situation where you don't have equity if you have to sell or something does happen. But having it free and clear doesn't make it all of a sudden worth more money. But now getting to the money is a lot harder. So I think the mortgage is really the last one you should pay off. Everything else should get paid first, because usually that extra $1,000 you can put to a mortgage, you can put to a car, a visa, savings, emergency, 401, annuity, all that stuff out there will go so much further than putting it towards that mortgage. So that's my soapbox when it comes to paying off a mortgage early. Rarely do I tell a client, yeah, it makes sense for you to do that. It really rarely it does, because there's just better places to put that money. Go buy another house. You're going to pay off this one. You could go buy 4 rental properties. You could pay off everything else you have. You could be your own bank if you have that money sitting there earning interest on it, especially if it's more than the interest rate you have on your mortgage. I just don't see the benefit of paying off a mortgage to get rid of that payment. So here's another fact. Soapbox. Here we go. Let's say you have a $2,500 payment and you've got 400,000 is what it takes to pay off that loan. Just an easy number. So 400,000. I'm going to take the math here. Okay. 400,000 divided by 2,500. That's 160 months worth of the payment. So you can just put that 400,000 in the bank, use it to make the payment, and you'll have a payment for 160 months. And while it's sitting there, you're earning the interest on it. That's if that 400,000 earns zero interest for 160 months. That's over 15 years. Or 13.3 years. So that's 13 years worth of that payment that you can be earning interest on the 400,000 instead of just having the house free and clear that'll appreciate regardless of what you owe. I just very rarely have I told somebody, hey, yeah, take your money and pay off your mortgage. All right. Whew. Oh, we got a call coming in. Well, I'm going to have to wait on this call. All right. Sorry about that. Okay. What else we got? How are we doing on time? Ooh, we're getting almost to the 1 hour mark. Oh, man. Can we turn down the light? Oh, there's a more natural light. Getting a little shiny. Let's see. What are the downsides of doing a reverse home mortgage? What is a reverse mortgage? Is a great question. This is for people that are over a certain age, 62, typically, unless you have a spouse that's under that, but at least one person has to be at least 62 years old. A reverse mortgage is exactly what it sounds like. Instead of the payment going down or the payment being applied and the balance going down, the balance is actually going up and no payments being collected. That's really how a reverse mortgage works. Is what they're doing is essentially taking the equity and using that to make the mortgage payment. So your balance is just slowly going up. Now, the theory is they don't want the payment to go up faster than what the home's appreciating at. So generally there's math that's done and they only loan, 60% of what the home's worth. So they have a ton of equity to make that payment forever, regardless of what happens with the market. And there's mortgage insurance on it. So even if worse comes to worse, you end up owing more than what the home is worth, then it's still covered by mortgage insurance. But they're only loaning like 60% of what the home's worth. So it is something where the benefits is no payment. You remove and eliminate that payment. You can even get cash withdrawals from the reverse mortgage so it can supplement your retirement, Social Security, annuity, pension, whatever that you happen to have. The downside with the reverse mortgage, there's still a lien against the property and the balance is going up. So the interest rate is being added to that balance. So every year your balance is actually going up. So essentially your equity is making your payment. That's really what's happening here. So that's really the biggest downside with reverse mortgage is that your balance is going up, but your appreciation should be going up. You should have a lot of equity on this program. So you'll still be able to leave money to your heirs or a charity or whatever you want that equity to go to. So you still should have money left over. And it should give you maybe a more comfortable lifestyle, be able to keep the home that you're in, maybe pull out some money to be able to do some repairs on the home. Maybe you need to build a ramp. I mean, I've seen the reverse mortgage be one of the better programs for people that need it, but I've also seen it oversold to people that just really don't need a reverse mortgage. So That's where you can talk with the loan officer, kind of go through the pluses and minuses. But the biggest thing people don't realize is, yeah, they don't have a mortgage payment anymore because their balance is going up to make the payment. The equity now is making the payment, not you anymore. Let's see. What are some good ideas to pay off your mortgage quicker? You can pay extra. That's really the only way to do it is pay extra. Round up your payment. Do biweekly. The biweekly payment's pretty popular, but it really is just better to just round up your payment $100 or $200 a month. Here's what I really would recommend is finding ways to make that money go further. Paying extra 1,000 or $200 or $300 towards your mortgage is great. But what I would do is say that same amount of money can go further by paying off other debts that can be then all the other debts are gone. Now you can really accelerate your mortgage, or you can increase your savings at the same time your balance is going down. I think that's way smarter. Takes more discipline. It takes more accountability on your part, which some people just can't do. I get it. If you start seeing your account at a certain amount and all of a sudden there's a new hot tub or car or four-wheeler or whatever you're into just pops up, it takes a lot more discipline to say no to that when you actually have the money to do it. But I tell you what, once you find the joy of that, once you find the joy of having money in your accounts and being able to do other things and not need loans and not need the banks and all that kind of stuff, that will override any kind of short-term love. One of the things that's really helped me in my career and with my rental properties is separating myself from that money. So as I've been able to, I actually have a couple different accounts to where I have my day-to-day checking and savings, but I have these other accounts for the rental income and stuff to come into that I don't have the checkbook for. I don't have the debit card. It's at a totally different bank. So if I need that money for an emergency, I got to go to that bank to get the money. I know that's a simple, stupid little thing, but I tell you what, buyer's remorse kicks in, or I'm like, boy, I really don't want to touch that money in that account. Or, hey, now I have this opportunity that popped up. Now I can go buy another investment property because I've let that money just kind of sit there out of sight, out of mind, doing its thing. Too many times people just merge the accounts together. So they open up their dashboard of their credit union or bank, see the little savings account right there. It's just too easy to click, click, move it, drag it, move it, whatever it is. Where if it just has that one step, now, you obviously you don't want to put it maybe as locked up as a 401 or IRA. I mean, that's when it really gets locked up and you can't get to it. But it's crazy how often you can create a account online, checking your savings or something that's online that maybe just a little harder to get to. You got to wait a few days for that transfer. You got to, you still can get to it if something happens, but it's amazing having that little step can save you from yourself. I've said this so many times on this channel and talking with people. The psychology of buying is way more powerful than your willpower. Flat out. I don't care. The lighting they use on these commercials, the lifestyle they offer, the sound in the background, all the things they're doing, the psychology of all the ads you see on football games and whatever's out there on YouTube and Facebook, all this kind of stuff. The psychology of that is way stronger than your willpower. It is. You've got to have systems in place. Willpower will only take you so far. But if you have a system in place that protects you from yourself, gives you a few times to be able to get off that want and desire, and you want to click on it, add it to your cart and all that kind of stuff. But if you have to take a little more time, it's amazing how often you're like, yeah, I really don't need that thing. I can live more of a minimalist lifestyle. I don't need that new widget and gadget and whatever that is. Or it's more important for me to see that account go up, or assets go up, or reserves go up, or when something really does happen, you have a safety net. It's amazing the stress that will come off your life knowing you've got XYZ kind of there, work in your system, and you have that money left over. So great. It's great to pay off the mortgage early. It really is. But I'm telling you what, that extra $200 to a mortgage is great, but $200 to other debts that maybe frees up $1,000 a month on a car or a couple cars that then you can roll down to the mortgage or increase savings other places. That's a better use of the money than throwing $200 at the mortgage. Now, round it up, make it comfortable. I mean, I definitely recommend you have a same system where you just round it up so you are putting a little bit extra to it, especially when so much of it is interest the first few years anyway. But $200 to a mortgage will only go so far. $200 to a car loan extra, that might pay it off way sooner. $200 to emergency savings built up over 5 or 6 years, you'll have way more money sitting over here than the balance you paid down on your mortgage. And boy, I'm telling you what, it's just a way to win at this game. It's a way to win at this game. All right, we are almost at the 1 hour mark. I was going to give this a little more time. You can jump on the chat, ask any questions you have about what we talked about. Tell me what I've said right, what I've done wrong. Let's have a conversation. Let's see if we can find a couple more. Here's that same kind of question. How do I get a mortgage with bad credit? Don't have bad credit. Why is your credit bad? What can we do to fix the credit? There's so many times I say, okay, client, you can get XYZ loan. But if we work on this for 90 days, 60 days, kind of do a few things here, you'll get a better loan. Why not do that first? Why not take some time to fix the credit, maybe learn to budget, maybe learn how money works a little bit better so you don't have bad credit? Why would you want a bad credit mortgage? A lot of these, why would you want the bad credit mortgage? Don't you want the good, the medium good, the great? And there's a lot of reasons why your credit's bad. If we can get to the why, we can fix the what. We can get you into a better mortgage. So having the time, now if you have a lease that's expiring in the next couple months, start working on your credit. Start seeing what's on there. That way you're in a better position to be able to get the better interest rate, the better loan. No matter where the interest rates are at, you'll always get better loans, better insurances, better almost everything if your credit is better. Maybe it's something you did as you were younger. 5 years ago, you signed up for a credit card or a cell phone or utility bill or something that went bad, or bought something online. I think there's all kinds of reasons why credit goes bad. Maybe you buried your head in the sand just hoping it would go away and you didn't want to deal with it. Well, it's going to come back to get you. It's so much better to just work on the credit. Know why it's bad, start going through it. Now, there's legitimate reasons why people have bad credit. Death in the family, injury, kids, medical bills. That's definitely a big damper on the credit. But most of it's just not knowing how it works, bad management, or just kind of hoping it'll go away. And it's amazing once you start fixing this and taking some pride in your credit score, other things open up. When you start knowing where your money's going, you start making better decisions with that money. You're not as tempted and just pull in every direction when some flashy thing shows up. So this is a systemic thing. That's why credit is so important. If we can start to solve that problem, I guarantee you other parts of your life are also going to open up. It's just how it works. All right, boy, it's just soapboxes everywhere. That's what happens when you start talking mortgages for an hour, I guess, and answering questions. I guess that's just the natural process. All right, let's see what else we got. Oh, is it better to pay off a mortgage or invest? I'm going to say invest. I'm really going to say invest. There's always going to be, with just a yes or no question, there's going to be nuance in all of them, but it is something where I think you're better off to invest. I really, really do. Because you invest, you can buy another property. Investing is more emergency savings, rainy day, paying off other debts. I think paying off other debts first is better than mortgage. So if I'm going to pay off debts, I'm going to start with other debts first, because the money I can put towards that debt will pay it off faster than the money I can put towards the mortgage. So honestly, I would say invest first, or at least look at the options to invest first. All right, we are just about out of time on the Mortgage Nerd Show. Is it even supposed to call live? I mean, I'm really new to this, so I'm just playing with it. Maybe I'll do it again. I mean, I don't know. Tell me what you think. What is the difference between a home loan, a mortgage loan, and a loan against a property? Nothing. They're all basically the same thing. They really are. Mortgage is maybe more official term for home loan, and a loan against a property is a mortgage or a home loan. So there really isn't differences. Now, mortgage can be a little bit different as far as how it's secured against a home, because you'll have a deed of trust or you'll have a mortgage. So there is some terminology differences, but really they're all the same thing. Just like a second mortgage, home equity line of credit, HELOC are kind of all the same thing too. But a home loan, a mortgage, or a loan against a property. Now, property can be different too. So property can be land, property can be personal property, but I mean, I'm assuming in this context it's real estate or commercial property, but it is something where a home loan mortgage is really the same thing. Let's see if we can find some good. Just refresh the screen here. I found a couple more. What are the different types of mortgage loans? We're gonna need a whole nother hour. There is so many different mortgage loans. It depends on the property type. It depends on, there's a lot of different mortgage loans. Let's just say that it's going to take way too long. We're already into this an hour. That's going to take way too long to describe all the different mortgages. But basically, all mortgages, just like it said in the question before, are tied against real estate. The terms of the mortgages, the qualifications of the mortgages, that's probably where the biggest difference is. But as far as types of mortgages, it's not maybe that many types. It's just what qualifies and what your payment's going to be and that kind of thing. All right. What is the minimum credit score required to get a home loan? I've seen crazy low. I mean, I'd say off the top of my head, you're probably a 580 is the minimum. But again, why are we trying to get the minimum score to qualify? What's the maximum score we can get your score to? That's the better question. But I would say 580, but you're going to do 10% down. You're going to have a lot more down payment requirements when you're in that sub 620, 660 range. So really the minimum score to start getting the better loans kicking in is going to be 660. And then after that, you're going to have tiers that are going to get you better rates and terms, different programs open up. So really 660 is a good number to strive for if you're really trying to get the better loans. But minimum, I've even had lenders out there will do like a 400 credit score. You know what I mean? So there's loans that are out there, but the people that need a 400 credit score mortgage loan don't have the 50% down that is required. So it's like, sure, the loan may exist, but you're not going to qualify. It's not like you have a 400 credit score and $1 million in the bank. Usually it's the sign that there's other problems that are leading to that lower credit score. But 580 is really going to become mostly the minimum scores you see out there, but 660 is kind of that number to strive for, where a lot of different options start to open up. All right, we are almost out of time. Why do I pay more? Let's see. Why do you pay for a home? Oh man. Wow. Why do you pay for a house the full amount when renting is far cheaper than a mortgage? Okay. I should have just scanned over that question before I stumbled through it. So, yeah, why pay for a house payment when renting is cheaper? So, here's the things I would say with that is a lot. I mean, yes, you're right. A lot of times you can rent a similar home for cheaper than what the same mortgage would be against that property. But here's the things I look at. Your rent is more than 100% interest. You're not getting any appreciation on the home. You're not getting any tax benefits for making that payment. The payment's not locked in. So, how often is your rent also going up? Now, so that's the thing you're going to see. A lot of times that mortgage is bigger to start with. But it's amazing how often I've seen somebody that was like a $1,500 mortgage payment. Now you can't even rent a house for 1,500 bucks. But maybe at the time they did it, maybe the rent was only 1,000 bucks or something like that. So it is something where rents are always climbing, where a mortgage stays locked in the whole time you have that house, in most cases, depending on your loan. But most cases, your mortgage payment's going to be locked in the whole time you are there. The other things that are benefit, there's a pride in home ownership. You can customize the home. Typically, you're getting more home when you buy than you are in a rental situation. Maybe you don't have neighbors and stacked above and below on the side. You have your own yard, you have your own fence. You can customize it the way you want. There's a pride in taking care of it the way you want. I mean, there's a garage that maybe you didn't have before. There's so many benefits of owning the home outside of just the fact, okay, the payment might start out higher, but it is in the long run, they will win. Every homeowner beats a renter over a 5-year period, 10-year period, whatever that period is on the home. And what happens when you move out of the house? Do you get to keep any of the payments you were making, any equity that the house has gone up since you were renting the house? No, you just are borrowing it for that time. We're owning it, you own it. Yeah, people say, well, no, I just rent it from the mortgage company. No, you own that home. You can sell it, you can rent it out to somebody else, you can change the paint, the color, the flooring, you can put a fence on. There's a lot of things. Now, there might be restrictions with HOA. I mean, these are all generalities, but it's something where homeowners win in the long run. Maybe the short term, they might sacrifice a little bit of payment in the short term, but they are going to gain so much more with the tax benefits at the end of the year, the appreciation they're going to get, the customizing, the privacy, the owner. It's just better. It's just better. It really is. So if you only can approve for 2,000 a month, and then guess what? Go get lists of homes that fit in that price range. And what you might have to do is you might have to expand that bubble out a little further. Maybe you will have to live a little bit further away than downtown XYZ city, but it's something where there is homes that will fit almost every budget. It's just a matter of how farther away they are. Or maybe there's things you can do to minimize your other debts in other categories to help you approve for a little bit more. So why do people pay for a house? Because homeownership's better. And when you're renting, you do have a mortgage, just somebody else's. All right. We are just, I mean, I'm having too much fun. What are the difference between a mortgage broker and a bank? Okay. Banks are typically going to have the checking, savings, car loans, all kinds of other types of loans associated and mortgages, where mortgage brokers, that's all they do is mortgage loans. Also, they typically have way more banks to choose from. So XYZ Bank has their portfolio of loans that they offer, and that's kind of it. Maybe they don't offer loans to everybody. Where a broker will have access to that bank and this one and this one, and maybe more options to be able to serve the needs of more clients. And that's all they do. Like, I don't do car loans. So I don't have to, where a lot of times at the bank, they kind of have all these different loan officers doing all these different things, where we only focus on mortgage loans. That's all we do is mortgage loans. And because we have more volume that we can generate with different mortgage lenders, we get better pricing sometimes, we get better services and all that type of stuff. So a mortgage broker quite simply will have access to maybe better rates sometimes, maybe not, depends on the type of loan you're trying to do, but they'll have a lot more products to choose from and be able to say yes a lot more often. And usually are going to be a little faster. They're usually a little more one on one with you. It is something where mortgage brokers just have more options. That's probably the biggest thing that's really going to separate them from a bank. Oh, I just found out my landlord filed Chapter 7 bankruptcy. Is it unethical or immoral for me to not make the payment anymore since he is not paying the mortgage? That's very interesting. So I would say yes, because I mean, this could go both ways. I could see why, okay, if you found out they filed bankruptcy, maybe you don't make your payment either because they're not making their payment to the mortgage company. But at the same time, if you miss that payment and you try to go get another property or something like that, the landlord's basically going to say, yeah, he stopped making his payment. He wasn't on time. He didn't fulfill his obligation. So just because he's filing bankruptcy, which is going to be his own problem, he's going to have to deal with all kinds of different problems. He might lose that property. He might lose his cars and all kinds of other stuff. And who knows why he's filing the bankruptcy? So I mean, that is definitely between him and the bankruptcy court. Where, as far as I'm concerned, if I signed a lease agreement, I'm going to honor that lease agreement. Now, maybe what you try to do is get out of it or change it or modify it. Maybe that's what you do and say, hey, you're not making your payment. Can we modify the terms? Something like that. Maybe there's something you can do there. But it is something where just because he's now filing a bankruptcy, which is an atom bomb to his finances and his credit report, why would you also want to go down with that in a sense? And if you end up trying to go buy another property or mortgage or something like that, and they have to call that landlord and say, okay, did he make his payments? Did he honor his lease agreement? He says, well, no, he didn't. They're not going to care why he's not making his payment. They're going to care why you didn't make your payment. So immoral is a strong word there, but I mean unethical. I would say yes. You signed a lease agreement regardless of what he's doing with the money. So if you found out that he was using the money to double his mortgage payment, would you then say, well, hey, you're doubling it, so I need to also get access to the equity? I mean, I don't know how to flip that around as other ways where you'd be like, okay, now I want benefit for me making the payment instead of just getting rid of the payment. But it is something where you're the one who signed that lease. You're obligated on that lease till it expires. It can have ramifications for you if you don't make the payment that may not be worth it, even if he's not making the payment. Now, what you can do is find out, maybe make the payment to the insurance, the attorney, the trustee, directly to the lender. I mean, maybe it's something where, hey, I don't want the guy to just get the money and then he just gets to keep it and doesn't get to go to his lender. What happens if the property was free and clear? What if he didn't have a mortgage on it? Would you then feel like, oh, I don't need to make my payment because the guy doesn't have any debt on the property? No, you'd still make your payment because you still signed that lease agreement. But I mean, that may be a way where you say, hey, I'm going to make this payment to somebody that where that payment's supposed to go, like to the lender or something. But I mean, it can have ramifications for you if you stop making your payment, just as much as it's obviously going to have massive implications for him by filing into Chapter 7. Let's see, what's the difference between a loan and a mortgage? So loan, now a home loan is the same thing as a mortgage, but a loan is just that's like the top tier, and then loans go car loan, mortgage, and other types of loans. So loan is still, I'm borrowing money from someone, a bank or something like that, and I have an obligation to pay back the loan. A mortgage is specifically tied to real estate, so you can't get a mortgage on a car loan. Now you can get a mortgage that gets you the cash to buy the car, but you're not directly getting a mortgage to lien or collateralize the car. So mortgage is specific to housing or getting a mortgage against real estate or property, where just a loan is any other loan where basically you're borrowing money from a bank or somebody or a friend. You can get a loan from your friend. It's still a loan. So it's kind of like in the evolution of the name. Mortgage is maybe down here. It's a little more specific, where loans more general. But yes, mortgages for properties. What are the mortgage loan interest rates? Depends on so many different factors. There isn't just one interest rate. You hear the Fed lowered the rate. Well, okay, what rate is that? So mortgage interest rates vary based on credit score, down payment, property type, occupancy, debt ratio, first time buyers, investment property, condo, townhome. There's just not one interest rate, and that's why you see most lenders don't just advertise an interest rate because they know not everybody qualifies for that rate. Or if they do, they advertise the rate that they do advertise. I'm always leery about mortgage companies that are advertising interest rates because there's 2% of the population qualifies because they want to post their lowest possible interest rate. But why would you want to call on a rate that they advertise at 5% and find out you don't qualify and you qualify at 7? It's kind of deflating. It's kind of like, oh crap. Just like all the car loans always have the advertisement. And then the fine print is just crazy, all that fine print. And you find out, well, I have to have like a I have to have like a purple heart and I have to have to get that mortgage loan. I have to have 99% down to get that interest rate. You know what I mean? I have to be on my job for 38 years and blood type O. And so, what are mortgage rates? They're really case by case. Now, there's some general rates. You can see a general average interest rate that's out there, and they change every day, just like do with stock prices or anything else. But so, really, the important thing is to get a free quote, talk with a mortgage lender, find out what loans you qualify for, and get a specific quote. That's what you want anyway. You don't want the rate that somebody else is going to get. You want your rate. So, all right, we are just about out of time. I've been saying that now for a while, but my wife hasn't brought the food in yet. I mean, what am I supposed to do? Make my own food? I guess I have to. All right, let's see. All right, you know what? We're having too much fun. Maybe we'll just end this. But if you have any questions, comments, concerns, put them in the chat. I'll answer them on a further stream. Maybe I'll try this again, but hadn't tried this live thing yet, and I just thought, you know what? We'll jump on here and see where we go with this. So appreciate your time. My name's Ryan Bolton. You can check me out on ryanbolton.com. I loan in Utah, Nevada, but our company's licensed in many different states. So if you have any questions, I offer advice. So maybe you just have some questions on loans or whatever. I'd love to answer your questions. So reach to me. My tags are going to be at MortgageN3rd on Facebook and here on YouTube. So ask any questions you have, and we'll talk to you next time. But I appreciate your time, and go buy some real estate. I don't know if I've done everything. Oh, it looks like it stopped. Oh, I don't know what I'm doing.